Hey everyone, in this video we're going to talk about two stocks that have just exploded over the last 5 years. We're going to go through some of their investor reports, we're going to look at their stock charts, their evaluations, their earnings per share forecast. We're going to go through everything. So if you like this type of content, before we get into this, be sure to subscribe to the channel. If not, give a thumbs up to this video. That really does help with the YouTube algorithm for small channels like mine, and I really appreciate it. If you have any comments on either of these stocks, we'd love to hear from you down in the comment section. I don't own either of these stocks, so if any of you guys have more information or perspective to share, please drop it down below. But we're just going to jump right into it. So the first stock that has just exploded over the last 5 years, you see it on the screen here, is Crocs. So Crocs is obviously a shoe company. They own the Crocs brand. They also recently acquired the brand Hey Dude that operates primarily in the US. This company right now is a $9 billion company, but if you look at the value of the stock price, it's gone up 800% over the last 5 years, which is crazy. And what makes it even more crazy is they've actually bought back a ton of stock in this company, which means that their valuation could have been even higher if they reinvested in other things and returned shareholder to capital to shareholder rather through other means versus just buying back the stock. But at the end of the day, if the stock's up 8 times, it means those share buybacks delivered really good return on investments for the shareholders at the time of those buybacks. So this stock is definitely one that has done well. Let's just look at some other time frames before getting into more information. Up over 100% over the last year. Year to date, up 40%. So it's just flying across all time periods, doubled last 6 months. So really interesting name here. It says it's trading 16, 17 times earnings. I guess we'll get more into that as we look through their earnings per share a bit later to see if that's accurate or not. But before going into some more of their financials, from their website, 3 reasons why they say this is a good company to invest in. The number one is that they have global scale in casual footwear. So they do over $3 billion in sales. Remember, the company's valued at $9 billion, so that's about 3 times sales. And they feel like their products are really in line with global mega trends in terms of casualization. And they also have some personalization capabilities, I think, specifically with their Hey Dude brand. They think they have 2 iconic brands in the space. They have strong financial economics, good margins, and they feel like they have a good business model, good cash flow generation, and then um, you can't argue with them on saying that they have good industry knowledge and they've been able to execute really well from a team and executive point of view because they have just obviously created tons of value on their share price over the last number of years. Going into some of their kind of timeline of the evolution of this company. So from 2002 to 2006, that's really where this company was born. And then it's interesting how they admit some missteps from 2008 to 2013. They talk about over diversifying their business, that resulting in poor gross margins, they call out here, bad go to market plans in geographies they shouldn't be in, overextension of many verticals of their business, and then very high cost base. They have SG&A was almost 50% of revenue. So at that point, you're not really setting yourself up to be an economically viable company. They're just chasing growth for the sake of chasing growth. And then that is what led to the beginning of the company as we see it today. 2014 to 2017, they announced a new strategy to think stronger in terms of how they can drive earnings and profitability and cash flow. And you can kind of just see some of the different things. If you want to read it all, you can pause the video and read it all. But essentially, they just kind of reset the business, reset the brand, focused on margins, focused on the P&L and making sure they're fueling profitable growth and making investment decisions that make sense for profit. And then that's really enabled them over the last 5 years to execute and deliver on that profitable growth. So over the last 5 years, they've experienced double-digit revenue growth per year. They finished 2022 with almost $4 billion of revenue. So once again, $9 billion valuation on this company, did about $3.6 billion in revenue. So trading about 2.5 times. They've repurchased $1.7 billion of shares since 2014 at $37.90 a share. So all of those shares, the shareholder who owned the stock during that time got a 400% return on investment on that capital deployed, which is really strong, obviously. And they're now obviously pursuing more sustainable ways forward, announced commitment to be net zero carbon emissions, and they acquired Hey Dude, which at first sunk the stock a lot, but it looks like it's working out really well for them. So the management team kind of proved the investors wrong a bit over the medium term on that one. Looking at the Croc brand, and we'll just fly through some of this, but revenue's up 20% this year. International markets up closer to 50%. So it's great that they're growing a lot in those new geographies. North America direct to consumer sales up 12%. So interesting to see that that's trailing. In terms of gross margin, about 57%, which is down about 5 points because of all the supply chain and cost of goods and inflation going on. I still think that's pretty strong in terms of an absolute gross margin, and it seems like they have their SG&A under wraps. So an adjusted operating margin of 33 points is definitely investment grade and a good place to be on their core business there on Crocs. In terms of Q4, you can kind of see here North America is really flat essentially. So lots of their growth on their business, especially in the fourth quarter, is coming from international markets, but at least it's coming in a huge way as they expand their distribution in those channels. And then from a channel perspective, this is good to see 22% growth on digital. We're going to talk about their Amazon business in a bit, but 20% on direct to consumer and then 13% through wholesale. So they're kind of firing on all cylinders from a channel perspective. Going on into Hey Dude. So I think they said, did they say how much they did here? 2.7 billion in revenue in 2022 to give you some perspective on the split of the business. Hey Dude, on this slide it says they did 900 million. The next one says they did closer to a billion. But essentially it's like a billion on Hey Dude and then closer to 2.6, 2.7 billion on Crocs in terms of the split of the business. So 3/4 Crocs, one quarter Hey Dude. But it looks like they may have some larger growth opportunities on Hey Dude. You can see that they grew 54% in the last year. Their adjusted gross margin a bit lower. I like to see gross margins above 50%, but I'm sure they're going to work on this with time, get it closer to the Crocs one in the high 50s. And their adjusted operating margins just about 3 points below Crocs, as their SG&A percentage is lower than Crocs. Going into the overall, this is Q4 overall business. So revenue growth really strong. We're seeing significant margin hits though, behind just all the challenges in doing business right now. And then SG&A went up. I think that's as they brought in Hey Dude, needed to bring in their advertising budget and work on getting them in distribution, stuff like that probably cost money. That had an impact on the entire P&L here. Diluted earnings per share slightly down, but I think it was not as badly down as people anticipated. And when they did the adjustment, so when they take out one-time items, it's actually up to 23% growth versus Q4 in the base. So the company's growing really strongly on top line. I'll give them the benefit of the doubt this, just given the environment and given the acquisition. But definitely one thing that I'd want to see flatten out and some more consistency on next year. Good that gross margins are over 50%. And I'll take their word on the adjusted diluted EPS. So 65% revenue growth, 23% EPS growth, probably strongly fueled by the Hey Dude acquisition. In terms of revenue by brand, as we go into this slide here, so I got it right on the head there. Crocs 3/4, Hey Dude 1/4. Product type, clogs are 60%, other types of casual products 40%. Geography, still 2/3 North America, so I like that mix. They have some geographical diversification, but still the core business is in the US, which is great. Really strong digital footprint at 38%, and then they have a really strong D2C business there at 45% of their overall sales. In terms of Crocs specifically, not too big of a change versus the whole company. You can kind of see their D2C numbers are up a bit more than wholesale, which I think is a positive. But overall, pretty similar to the combined company with Hey Dude. And then as we look at 2023 guidance, so 2023 guidance for the full year is $11 to $11.30 by the company. They're expected to have capex of about $175 million, let's call it, and they think they're going to grow their overall business on Hey Dude by mid 20s and Crocs high single digits, let's call it, which has the combined company going at a low double digit growth rate. So low double digit growth rate, $11 EPS, which is growth as well. Still $30 million in one-time costs. They're assuming a tax rate, so there's some changes that could happen here. But this is still decent growth for the company. As I look at their capital allocation, they don't pay a dividend, so they're really invested in making sure they can synergize the business with Hey Dude first. Then they really want to get below 2 times gross leverage. You can kind of see here how quickly, since 2021, they've been able to delever from kind of 3.1 down to 2.25, and mid 2023 they want to get to under 2, which I think is the right move for them given some of the volatility that could happen given the discretionary nature of this business. Always good to be in a position of strength from a balance sheet perspective. So I think that's the right capital allocation decision to make. And then lastly, share repurchases, which is really how they return dollars and capital to shareholders. They don't really pay a dividend, so just buying back shares. And that just kind of goes towards their long-term belief in the value of the company as well. Just like over the last 10 years, how every share they've bought in, they've created a 4 times ROI on that money by driving the value of the company up later. They're probably going to continue feeling they can do that for the shareholder. I just wanted to show you guys something in terms of Crocs, just to show you how much business these guys do online. You can kind of see here, just by the reviews, like 70,000 reviews, 55,000 reviews. This is a huge distribution channel for them. I go to Hey Dude, and it's a very similar thing. The Hey Dude shoes, they have 35, 60, 20,000 reviews. This is just indicative of a business that does a lot of volume online and has a lot of repeat customers. They don't need to go in, they don't need to try them. They know their size, they know they like them, they know they're comfortable. So very loyal customer base likely in this kind of casual footwear space. As I look at what analysts think they'll do, so they think in current year they'll do 11 to 11.35. Looks like analysts are spot on. Some analysts think they can do up to $12, but I'll kind of take that 11.20 number. And if I look at 11.20, they're trading. It says they're trading about 16 times earnings trailing. Forward earnings, they're really trading closer to 13 to 14 times. So company's not overly expensive relative to the market. The market trades at a high teens multiple. So you're getting a lower multiple here. I think these businesses are a bit more volatile and a bit more, or let's call it not as resistant to a recession. Because people don't need to be buying a 4th or 5th pair of shoes, which I'm assuming like a Croc pair would be. So their business can get hit hard likely if things go south, and that's why this company's always traded at a low valuation. They've taken advantage of it by buying back shares and executing really well. But I think like a low to mid-teens multiple is probably where this one deserves to be. If you just believe in the management team, think they're going to continue delivering no matter what the economic landscape, then maybe not a terrible time to get into this one. But I'm going to keep watching it from the sidelines. They've done so well over the last 5 years, and I hope they can keep it up. But it's just the stock used to trade well under 10 times earnings. The stock's obviously gotten the confidence of the company now, given how well they've executed in the Hey Dude acquisition, performance growing 50% last year. But this is one that I don't think is necessarily a steal by any means, trading at 13, 14 times earnings. Definitely a great company, and they definitely executed really well. And that's why they are on the list of stocks I'm talking about today. Going into the second stock that I wanted to talk about today that has just been going up like crazy is Chipotle. So Chipotle not up as much as as Crocs, only up 320% over the last 5 years. As we look at this company, unlike Crocs, which has kind of been a bit up and down with COVID, Chipotle rather has been just steadily going up and up and up over the last 5 years. $50 billion market cap on this one. So that's really big for a restaurant company. Obviously, McDonald's is a multi-$100 billion company. But after that, I'm having a hard time thinking of a company in the restaurant space, especially the quick service restaurant space, that's as big as Chipotle. I think Domino's is like a 15 billion. Quick service restaurants that owns multiple brands is 30, 35 billion. Yum Brands, I think, is about 35, 40 billion. So it's interesting to see Chipotle, which is 99% of their business under the Chipotle brand, is a huge player in the quick service restaurant space, $50 billion company in terms of value. They are trading at a trailing PE of 56. So this company is expensive, and we're going to look at some of the reasons why. Before going into some charts, we're going to look at their earnings report. So they just recently reported their full year 2022 earnings. And just to give a sense of some of their numbers here, remember they're valued at right about $50 billion right now. Last year, their revenue grew 14% to $8.6 billion. Same-store sales increased 8%, which is a phenomenal number. In-restaurant sales increased 26%, while digital sales increased 39% of food and beverage revenue. So now 40% of sales essentially are coming from digital sales, I guess is the right way to read that. Operating margin, 13.4%, an increase from 10.7%. Operating margins tend to be low on these kinds of companies, so definitely one of the things is you're paying 50 times earnings to keep in mind, and hopefully they can continue to grow that with scale and as they continue to fine-tune their business. EPS was $32, which is a 40% increase from $23. Adjusted EPS, which excludes, oh, was that the adjusted EPS? Okay, adjusted EPS was 32.78, so even higher, but just a 29% increase. So as I'm stumbling through this, you can kind of see this company's in like hyper growth mode, double-digit growth top line, double-digit growth bottom line in terms of EPS, growing same-store sales by 8%, opened 236 new restaurants in with 202 locations, including a Chipotle. I guess that's their name for a drive-through. But that means that if you own this company, while you're paying 50 times earning, you're almost getting like essentially every week they're opening up 5 new businesses for you across the world that are going to continue to be profit centers for you in years to come. Going into some more just charts I wanted to share on Chipotle before looking at their future earnings per share. It was really hard getting information on this company in terms of like nice glossy PowerPoint presentations from investor relations. They're pretty bland investor relations reports given the size of this company. So I had to go online and find some things. Some of these are dated, but it just gives a good sense of this company's really been growing for 20 years. So this is an early chart of 2005 to 2013, just how quickly they were growing restaurants. They went from 450 or 500-ish to 1,600. So 300% growth in 8 years of restaurants. You kind of see they're continuing that nowadays by opening up almost a restaurant a day in 2022. Hopefully that continues in 2023. And then from a same-store sales growth perspective, this just shows them versus the industry. So in 2018, growing at 4%, which wasn't bad. That's a solid number, better than the industry. 2019, before the pandemic, just blowing up, growing 11%. Then 2020, even though the whole space went down 14%, they still slightly grew sales as people probably ordered through delivery and stuff like that. I don't know what 2021 was, but we just saw 2022 was back up at 8%. So they just continue to gain market share, grow new locations, but then in addition to location growth, also just revenue growth per location's going up. So it's a really powerful compounding model on revenue for the company. which is helping it justify its huge price to earnings ratio. And this is in billions revenue year over year ending 2022. So you can kind of get the sense here that it's going up and to the right pretty quickly, pretty aggressively, especially over the last 2-3 years. So a lot of momentum on this business, and they've been able to show the capability to turn that top line revenue growth into earnings per share growth as well, which has been good for investors. This just shows annual revenue as well. So same chart. I was essentially just showing with a couple less years of data. But what I liked about this one is it showed their footprint as of the end of 2018. So they keep expanding, but you really see they're all over the east coast of the U.S. here. They've also expanded into Canada now, and they also are down in California pretty aggressively. So they still have opportunities in some other areas of the U.S. And in other countries for sure to expand their locations, their distribution. They obviously have a business model that makes sense. So that, along with what they're doing in current store restaurants, like store openings and same store sales growth, it's a lot of growth vectors for this business in the years to come. And then this is just another same store sales quarter over quarter. So you can kind of just see, obviously Q2 2020, everyone had a hit, but they just consistently quarter over quarter, sequentially, and year over year are cranking out really good numbers on the business. Okay, so back to what we were talking there. In terms of EPS on the business, oh, that's not my EPS chart. This is the balance sheet. So I can talk the balance sheet first. I'd say for a $50 billion company, their balance sheet's not in bad shape. $7 billion in total assets, about $1 billion in cash in there. And then on the liability side, you have about $1 billion. And then some of this is like rent for their property. So I don't really like counting that even in liabilities. It's like a month-to-month expense. But they have a pretty clean balance sheet, okay? They're not like hoarding a bunch of cash like Apple or Google or anything. But overall, it's a pretty clean balance sheet. And then if I'm going to go look at earnings estimates by analysts for next year, note it's a $1,800 a share company. So $42 for next year, and then $51 for the year after. I'm just going to go back and look at what they announced this year. So they're at $32. So investors think they're going to grow their earnings another 30% this year, and then another 20% after that next year. So that's huge. That by the end of 2024 to get from $32 or $33 all the way up to $50. And let's just look at if they did do $50 in 2024, what would that look like? So that would essentially look like this company being a 36 times earnings multiple. So if everything goes well, it's still not a cheap company, right? You're talking about a company that by the end of next year will be trading 36 times, which is double what the market's trading today. So you really have to believe that they're going to continue to be able to grow at these kinds of clips for the next 3, 4, 5 years to justify buying this company at a 50 times price to earnings ratio today. My thoughts on Chipotle is it is a great company. They've executed super well. They have a great product, great pricing power, a lot of growth vectors that we just went through in terms of just naturally growing same-store sales, but also being able to increase their penetration of new restaurants, expand internationally. I think this company's going to do really well. I just think it's already priced in to a great extent over the next few years. So this is one that's tougher for me to get behind just because I can't really swallow that 56 times trailing PE. Also, since they're in growth mode, you're not really going to be getting a dividend or really a return of capital in the short term. So this is one that isn't my style of stock, but wanted to call it out for you guys just because they've been able to grow so aggressively over the last 5 years for anyone who may want to jump on the train if you think it's going to continue to go up. So that's my video for today. I hope you guys like this video going through two stocks that have just been exploding over the last 5 years with Crocs and Chipotle. If you like this type of content, be sure to leave a comment down below. Let me know your thoughts. Also, please like this video. It really does help with the YouTube algorithm. Also, if you've made it this far in the video, let me know in the comments below because most people don't make it to the end. So I'd love to hear from you guys who do. Thank you guys so much, and I'll see you guys in the next one. Bye.